Welcome to The Close. I'm Marilla Fernandez. The U.S. markets close today for the July 4th holiday. The TSX will close in a half an hour's time. Here are the stories we're following out of the BNN Bloomberg newsroom. The finance minister, Francois-Philippe Champagne, is pushing back on the idea that Canada will have to settle for a new baseline tariff with the U.S. Champagne also suggests Canada could even receive a better deal than other countries. In an interview, he emphasized Canada's critical minerals and energy sector and integrated supply chains with the U.S. Alberta's oil production fell in May to the lowest it's been in 2 years as wildfires played out. Output fell to 3.6 million barrels a day. That's a drop of about 400,000 barrels a day. Major energy producers like Cenovus, MEG, and Canadian Natural Resources were forced to halt production after a fire near Cold Lake threatened operations. Toronto home sale prices fell for a seventh month in a row as U.S. tariffs continue to slow the Canadian economy. The benchmark price of a home in Toronto in June fell nearly 1% to just under $980,000. That's coming from the Toronto Regional Real Estate Board. While new listings are down, sales rose 8.1% from a month before. As we mentioned, the American markets are closed. We're only taking a look at the TSX this hour. It is up 24 points and, again, on track for another record close. We'll check back and see if it makes it, but well above the 27,000 mark again today. We have the challenges of the tariffs, prospects of a weakening economy in the second half of the year. Still, the markets are on a tear with record highs. So what does the second half of the year hold? Let's bring in Sam LaBell. He's portfolio manager at Veritas Asset Management to talk about that. Thanks for coming in.
Thanks for having me.
So let's talk about themes for investors at this point. I also just want your take on the fact that record highs for North American markets. The TSX has been hitting record after record. Do you expect this bubble to deflate a little bit in the second half of the year, the enthusiasm?
Well, there is definitely that possibility. I would point to the fact that this big bill that they signed in the U.S. is, at its core, it's a stimulus bill because the spending is going to rise, cuts on taxes for tips, all these other little pieces that fit into it. So we're looking at a situation where the U.S. is going to continue to run deficits for a long time. And out into the forecast period, you're looking at 6-7% of GDP deficits. So that's a lot of stimulus into the economy. The question for everyone is why have the markets been so strong faced with tariffs on practically everything from every country? How is it that the market isn't a little bit more worried, especially since in the U.S. there's a lot of consumer spending built into that stock market? And I think the reason is that you've seen a couple of things happen in the U.S. First of all, savings rates have gone way down, meaning people are saving less and spending more. So there's a bit of a paradox there where the savings rate before the pandemic from 2015 to 2019 was roughly 6.5% of GDP on average. And now it's down in the first quarter of 2025 to 4.3%. So that's a big stimulative lift of people going out and spending. But the paradox is that if you look at 401k savings rates, which is a percentage of your income going into 401ks, that was at a record high in Q1. It was up more than 200 basis points versus the pre-pandemic period to about 14.3%. So people are saving less. But they're putting the people who have income are putting a lot of their money into the market and are comfortable putting more and more into the market. So there is a confidence in stocks that hasn't been shaken, and it's possible these tariffs will not shake that confidence in stocks. That's kind of an automatic debit that happens every month, and people are comfortable continuing to put it in. There's not a valve that they're likely to shut off. So I think what's happened is that people are not saving as much in terms of paying down debt. Debt is starting to creep back up. Again, it's not at emergency levels in the U.S. yet. You're kind of above pre-pandemic levels, but you're not seeing any critical signals that the consumer is in trouble in the States.
Okay, but the sentiment for consumer has been down.
Yes, and so sentiment, I think the sentiment is disconnected from market dynamics and economic dynamics for a while now because of all the political turmoil, because of the division in terms of politics. People, a lot of rhetoric in politics about how this is the worst economy, and it's not the worst economy. It's actually the best economy the U.S. has ever had. Unemployment rates are very low. People have jobs. Graduates are getting jobs at record rates. There's upward wage inflation. So people are doing quite well in the U.S. economy, but there's this feeling because of awareness and maybe a bit of jealousy about how the guy down the street is doing that things aren't great. And that's been in the consumer sentiment file for a while. And you've had very low levels of consumer sentiment, but not correlated with actual spending. So that consumer sentiment survey is all about, are you going to buy something? Do you think you'll have a job in a year? And so when it's very negative, it's just a pessimistic outlook. But at the same time, people are spending their money. So it's a disconnect between spending intentions, as they say in the survey, and what they actually do.
Okay, so talk to me about tariffs and how you see the second half of the year, because the threat for people has always been that second half of the year. We have the July 9th deadline. We know Washington's already starting to send out the letters to say, instead of negotiating, here's your rate. And that has to unwind. And then the 21st is the deadline for the Canada-U.S. agreement. What does that second half of the year look like with all of this happening now?
So an important thing to think about in terms of tariffs is that it's an ad valorem tax. So here we have the GST in Canada. Everybody's familiar with that. You get your price, and it's always higher because you have the HST on top of it. So if we saw the U.S. put on a consumption tax, I don't think anybody would worry about it. They'd say, okay, well, everywhere in Europe faces a consumption tax, but they don't want to do that. Instead, they put on a tariff, thinking that somehow they could pass it on to other countries. I don't believe that's going to happen. It will go to the consumer. So if you think about the tariff as kind of a scaled-down version of a consumption tax, a 10% tariff on imports, it's a really narrow fraction of what people are spending. It's not on the entire economy. And it's helping to balance a budget which we would think is in crisis levels if you didn't have that tax revenue. One way that they got this budget bill through is to say that there's lots of tariff revenues coming in. So I think we need to put that in perspective and say that it's not going to kill consumption. If you had a 10% across the board tariff on all imports in the U.S., it wouldn't kill consumption. It would affect probably the U.S. dollar and their ability to buy things.
And you think that 10% is where it'll land? Well,
I don't think it'll land at 10%, but you're probably looking at a blended rate somewhere in the 10 to 25% range across all products, and we'll see how it works out. But it's not as much of a disaster as you might think. It will slow spending. It does affect, obviously, the lower your income, the more direct impact it has as a percentage of your income if you have to go out and spend on goods additional amounts because of the tariffs. Yeah. I think it will have a big impact on the auto sector because steel and aluminum, of course, have the highest rates right now. That's a big input cost for vehicles. And so you've seen a lot of spending pulled forward to try to avoid some of these bigger tariffs on autos specifically. So there is some softness coming in the second half in the data. We're not seeing it in employment because I think people view the stimulus that's to come. A lot of companies are not laying off because they want to be ready if demand should rebound in the next year or so.
Very quickly, because I'm running out of time with you, I just want to get a couple of stock pick ideas right now. Where are you telling investors they should look given sort of the in-between time we're in?
So given that we kind of have a middle-of-the-road view on where the economy is headed, we do like some of the beaten-up names that are value picks. We've started adding a little bit of Alimentation Couche-Tard. It's kind of a name that the institutional community, when they announced the 7 & I deal, they didn't like the idea of going after 7 & I. It's a bit of a strategic impediment in the short term to doing other things. And so a lot of institutional money flowed out. But we think it's actually gotten into value territory here. It's about 20 times free cash flow. It's a solid business. It's going to lap some of the weaker comps. It did see some weakness in the quarter in terms of U.S. comps. Memorial Day was a big issue for a lot of retailers because it had bad weather, and so that carried over to people's spending. So you're getting Couche-Tard at an attractive price. If 7 & I goes forward, it's accretive, but we don't think it's necessary for you to get a good value at this price. We also could like Canadian National Railway. We like both of the rails, but Canadian National has a bit more discount in it in terms of an 18 times forward PE. That's a discount to the average over the last couple of years, which has been over 20. And it has a little bit more exposure to commodities, which we think will do well in this demand environment. We think commodities will hold up. And if you believe inflation could come back to any extent, commodities are a nice place to be.